Hi, and welcome to 60 Second Money. Back to basics. Today we're going to be talking about dividend investing, specifically how to double your return in 10 years. So we're going to look at the dividend growth rate. What is it? Why it's important? Take a look at a real example, and of course take a look at what the catch is and what's next. So let's take a look. The dividend growth rate is the rate at which a company increases their dividends annually. Good dividend companies are often able to increase their payouts every single year. So this can double your payout over 10 years. How? Let's take a look. Let's take a look at a real-life example. Royal Bank increased their dividends from 2002 to 2012 at an average rate of 11.6% a year. So if you can only get 10% a year, that means your 4% payout becomes an 8% payout in a decade. You can effectively double your dividend income without really taking any more risk. Now, is there a catch? Of course. Companies with the high dividend growth rates often have a low dividend yield. Now, keeping in mind your dividend yield is the annual amount of the cash distributed to you divided by the stock price. So if you get $1 a year in dividends and the stock price is $10, that means you have a 10% yield. One thing to keep in mind is that past performance does not equal future returns. Royal Bank, for example, is unlikely to repeat that performance in the next 10 years because their business tends to be slowing down a little bit. So in summary, good companies grow their dividends every year. This is called the dividend growth rate. A 10% growth rate can double your payout in a decade. So look at this before you purchase it, but keeping in mind that a high dividend growth rate usually equals a low dividend yield. Up next, we'll talk a little bit about how to juice your stocks into a higher payout. This is 60 Second Money. Thanks for listening.